Welcome back to Morning Trade Live. Let's talk some charts. Little Monday morning Meisler. Helene Meisler joins us, contributor at realmoney.com. It's been too long, Helene. Great to have you here on a Monday to kick off the week.
Hey, Oliver. Thanks for having me.
Absolutely. Obviously, this morning we've got the bond market selling off again. Yields making highs. Stocks have come under some pressure. What's kind of the number one indicator or chart that you've been looking at right now as things have gone a little bit south for bulls the last few months?
Yeah, well, obviously you can't talk about stocks until you talk about bonds, right? Bonds have been in a bear market. If you think about it, I hate all that bubble talk, but if you think about it, you had a bubble burst and now you've been coming down for nearly 2 years. And now we're sort of, I think, in the final throes of getting a short-term low. I don't know where it is. Let's call it, it's going to be probably just somewhere north of 5% on the 10-year. And then, you should get a rally because sentiment has gotten too negative and you get a bounce. But, I don't think you're at the lows. You'll be at a low. So that's kind of what I'm looking at first. And so I think if bonds stabilize, you could get a rally in stocks. But my problem with stocks is that too many are still looking for a year-end rally. So the sentiment is not bearish enough. Sentiment is plenty bearish on bonds, not plenty bearish on stocks.
It seems like a good lesson in bonds that it takes a consensus to move price, right? Even though it's like everyone's bearish on bonds, they keep selling off. But to your point, it's like hard to even think about, I guess, what's possible to the upside for stocks until bonds slow down. That's kind of like our baseline starting point for analysis.
Right. And so just for example, I've been looking at a lot of the sentiment indicators on stocks. And as surprising as this is, as of late last week, they were still leaning too many bulls. You had, if you will, in the Investors Intelligence Survey, you had 51% bulls. I mean, that's ridiculous. And I assume that this week it'll come down quite a bit. But again, as of last Wednesday, it was 51%. And you had and I'm not a big fan of the American Association of Individual Investors survey, but even there you had the same number of bulls as you had bears. That's what we're looking at here is the Investors Intelligence. And you can see that's just too high, considering what bonds are doing. Wow. And then if you take a look at the National Association of Active Investment Managers, where they tell you as of Wednesday morning what their exposure to the market is, last week it was 66. Well, that's not good because you were down in the 40s just a couple of weeks ago. So in other words, they're all still a little bullish. You need all that stuff to come back down. You need people to give up hope for that year-end rally, and you need bonds to stabilize. So that's kind of where I think we're at in the market.
I guess I didn't realize the sentiment element there is quantified from these two surveys. Far from bearish sentiment, to your point. I mean, it's not like screaming frothy bullish, but it's pretty darn elevated. I mean, both of these.
It's complacent. But I will, here's a tidbit. So every Saturday, I do a poll on Twitter.
I love that.
I've been doing it for almost 4 years now, 3.5 years. And I ask what the next 100 points in the S&P is, people's expectations. But a month ago, I asked because, again, a month ago, I thought too many people were in the year-end rally camp. Everybody's looking at that seasonality thing. And we had 67% responded yes, they were looking for a year-end rally. The good news is I did the survey again this week, and only 59% are looking for a year-end rally. So we've taken a lot of that froth out of that year-end rally cry. Okay,
it's still a majority, though, are looking for it. By the way, for the record, I ascribe more closely to the Helene Meisler Saturday poll than any of the other sentiment surveys he gave. I'll take the Twitter clicks before I will the mail-in, rebate survey.
Well, in fairness, if you take a look at my weekly survey that I do on Twitter, my people generally tend to be right, not wrong. They're not contrary. Whereas these surveys that we're looking at tend to be contrary.
You've been charting it for a while too.
Yeah.
You've been literally quantifying this for some time. I'm looking at it right now.
Yeah. So like in mid kind of late September, people started voting up in my survey, and then we got that 4 or 5% rally. And then they started voting down. And I want to say the last 2 or 3 weeks, they've been voting down in my survey. So my Twitter people are not contrary, generally speaking. And
not in small amount either. You get some good volume on it. So it's pretty interesting. So they're still majority positive. The surveys, NAAIM and the other one are also still pretty elevated. I mean, it's kind of surprising given how much the bond market has moved, but I guess it's kind of been a question how stocks were going to respond to this type of bond sell-off, because it's a different type of bond sell-off with the curve and everything compared to a year ago. But it doesn't seem like stocks really care so much right now about the details. They just kind of care about the direction in which rates are moving. What about from the overall, like, just levels, Helene, for it seems like the NASDAQ's a little bit stronger than the S&P still. We haven't like cracked that summer low necessarily.
Well, NASDAQ gets held up because of, those mega cap names. So if you crack the mega cap names, you'll crack NASDAQ. But what's interesting is that in the last week or so, the S&P has actually been outperforming NASDAQ, I want to say in the last 3 or 4 days. And that's a little bit of a change.
Yes.
So we've got to watch that, because that would imply that people are gravitating more towards safety than they are towards growth. And so that shift is starting to take place. And I consider that a sentiment shift. So even if I don't have a chart of it, but if you take a look at the triple Qs, we have not had a volume day over 75 million in months. And last Thursday and Friday, we got back-to-back 70 million share days on down days. So people are starting to sell those names. That's a sentiment shift too. I'd love to see an explosive down volume day for the Qs, because that would tell me people are panicking and getting out.
That's interesting. So volume was pretty light. I mean, volume was always a little heavier on the selling days, but you're saying it like exploded past the threshold you were looking for. I guess thanks to kind of Tesla kind of spoiled it for us last week.
Well, let's not rationalize an indicator. 70 million shares is just more than we've seen in certainly in the entire decline from August.
Okay.
Back-to-back 70 million days shows me that there's been some selling taking place. And, you can't get a low until you get any kind of good selling, because otherwise every time you rally, sellers come out. So you need that kind of selling.
Last week, I want to make sure we got to this point too before the bell rings here, Helene. For a moment, looking at one of your overbought, oversold indicators, we were like overbought pretty recently, right?
Last Wednesday.
Oh, wow. So that kind of rolled over quick.
Well, think about it. Prior to NASDAQ and the S&P rallied 4 or 5% over the prior 2 weeks. We kind of forget that.
Very true. We got to jump. Bell's coming up. Helene, thanks very much. Always love the perspective.
Thanks, Oliver.
Yeah, absolutely. A good indicator of sentiment with the polls plus Helene's own showing still a pretty good amount of bullishness in this market despite the big run up in yields. Wash some of that out, perhaps, and look for a pause in bonds before stocks can find the footing. Thanks to Helene Meisler, as always, from realmoney.com.